Right, let's jump straight into it. Picture this. It's a typical Sunday afternoon, and an Aussie couple, let's call them Chloe and Liam, both in their early 40s, are sitting at the kitchen table. They've got their coffees, they're looking over the household budget together, and naturally, they start dreaming about saving up for their next big family holiday.
While they're crunching the numbers, Liam brings up something he heard at work. He says, a colleague was telling me they've got an SMSF. Chloe looks up, kind of curious, and says, that type of super sounds interesting, but can you actually use the money whenever you want? And Liam pauses. He says, I'm honestly not sure. I think that's where I got confused. People say you have more control, so I thought maybe that meant having access to the money. Chloe thinks about it for a second and replies, I wonder if it actually works differently, because it's still retirement money, right?
And that right there is such a fantastic question, isn't it? Does having more control of your super actually equal personal access to the cash? Well, I really want to validate Liam's thought process here because honestly, confusing investment control with personal access is easily one of the most common misunderstandings for Australians looking into SMSFs. When we hear the word control, our brains just naturally jump to my money, my rules, right now. But as we're going to see, when it comes to an SMSF, that is a really dangerous assumption to make.
Think about your standard everyday savings for a second. That's money you can use entirely freely. If Chloe and Liam want to dip into their personal account to book those flights to Bali or, fix a broken washing machine, they absolutely can. It's totally up to them. But on the flip side, we have SMSF money. It is so absolutely vital to wrap your head around the fact that your SMSF is a completely separate entity. The money inside it is strictly locked away for your life after work. It is literally not your personal money.
Now you might be wondering why that strict separation even exists. Under the rules, there's something called the sole purpose test, and it is basically the absolute bedrock of the superannuation system. It means the fund has to be maintained solely for one core purpose, providing benefits for your retirement or for your dependents if you pass away. So what does that actually mean in plain English? Basically, it means the fund exists strictly for your future self. Under no circumstances is it allowed to act like a personal bank account for current day enjoyment.
So if Liam can't tap into that money for a holiday, what does control actually look like in reality? Well, the real flexibility of an SMSF is that you, acting as the trustee, get to choose the specific investments. You determine exactly what assets the fund will hold, you set the overall strategy, and you manage those assets directly, rather than leaving it all to a massive retail or industry fund. But, and this is a massive but, you are absolutely not treating the fund like an ATM. You control exactly how the retirement money is invested, but you definitely do not get early access to the cash itself.
Which brings us to a really practical concept, setting a line in the sand. The regulations call this the separation of assets. Basically, all of the fund's assets must be kept completely separate and clearly identifiable from your own personal assets. And look, this isn't just bureaucratic red tape. It's a totally normal, manageable boundary. For someone like Liam, it just means keeping his everyday household budget completely 100% separate from his super fund's money.
So how do we actually maintain that line in the sand day to day? It really just comes down to a few practical boundaries. First off, you've got to use completely separate bank accounts. Secondly, you need to make sure all your investments are correctly named so there's absolutely no doubt they belong to the fund, not to you personally. And third, you never ever pay personal expenses from the fund's accounts. I actually like to think of these rules as reassuring guardrails rather than intimidating legal threats, because actually, following them protects your super from things like personal bankruptcy or business creditors simply because those assets legally belong to the trust, not to you.
But, what happens when people do get this wrong? Well, let me share a quick example. There was a real-world case where a fund member completely blurred these lines. They basically treated their SMSF bank account like their own personal transaction account, and they even used fund money to pay for a personal course they were taking. Naturally, the authorities found that using the SMSF for a personal benefit was a massive breach of those core rules we just talked about. And as you can imagine, it led to some really serious and frankly very stressful consequences. And that right there beautifully illustrates exactly why this separation matters so much. Honoring this boundary is absolutely crucial for protecting your nest egg. Because if a fund breaches these rules, it actually risks losing its complying status. And if that happens, it loses its special concessional tax treatment, which can take a huge chunk out of your retirement savings. For folks like Chloe and Liam, getting this stuff right shows clear intent to the regulator that they are doing the right thing, and it completely avoids unnecessary personal liability. At the end of the day, it's all about protecting your future. So ask yourself, are you treating your super strictly as a foundation for your future, or are you mistakenly looking at it as a backup bank account? It's a line you really never want to cross. This content is general and educational only. It is not financial advice. If you already have an SMSF or would like to better understand your compliance responsibilities, speak with the Wendy Super Accounting team.